on the track, boy.
Hello everyone, and welcome back to the hashtag Just Accounting series. We are already down to our last episode of this series. I am Jonalyn Arfrando, and for today's video, I will be discussing the financial statements. Listen carefully as we dive deeper into this topic. What are financial statements? Financial statements are structured representation of the financial position and financial performance of an entity. The objective of the financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making sound economic decisions. Financial statements also shows the results of the management stewardship of the resources entrusted to it. In layman's language, financial statements are the end products of the accounting process. This refers to the accountant's report based on the data gathered, accumulated, and processed in the financial accounting that are periodically communicated to a variety of users, particularly the owners and the creditors. The financial statements that are prepared on a basis that is designed to provide useful information to a wide range of users, such as the investors and creditors, who are not in a position to demand reports tailored to meet their particular needs, are called general-purpose financial statements. Financial statements that are prepared to cover less than a year period are called interim financial statements. There are 6 basic financial statements as per revised PAS number 1, which includes: first, a statement of financial position or balance sheet at the end of the period. Second, a statement of comprehensive income or income statement for the period. Third, a statement of changes in equity for the period. Fourth, a statement of cash flow for the period. Fifth, the notes, comprising a summary of significant accounting policies and other explanatory information. And lastly, a statement of financial position at the beginning of the earliest comparative period when an entity applies an accounting policy retrospective or makes a retrospective restatements of items in its financial statements, or when it reclassifies item in its financial statements. Moving forward, I will present to you the 3 out of the 6 basic financial statements, namely the statement of financial position, the statement of comprehensive income, and the statement of the changes in owner's equity. First on the list is the statement of financial position. The statement of financial position is a statement that shows the financial position of an enterprise as of a particular date. It measures and evaluates terms of the enterprise liquidity, solvency, financial structures, and capacity for adaptation. Liquidity is the stability of the enterprise to meet currently maturing obligations. Solvency is the availability of cash over the longer term to meet maturing obligations. Financial structure is the source of financing for assets of the enterprise. It indicates how much is borrowed capital and how much is equity capital. Whereas the capacity for adaptation is the financial flexibility of the enterprise to use the available cash for unexpected requirements and investment opportunities. The statement of financial position is previously known as the balance sheet, which shows the assets, liabilities, and owner's equity. So what is assets? Assets in layman's language, these are the things of value or rights that are owned and used by the business in the conduct of its operation, which includes cash, land, building, inventories, furniture and fixtures, machineries and equipment, prepaid expenses, and etc. Aside from that, it also includes accounts collectible by the business, which is termed receivable. This also tells us how much the business owns. Liabilities in layman's language. These are the debts or financial obligations of the business that are payable in cash or in some kind of assets. Liabilities include accounts payable, notes payable, salaries payable, mortgage payable, etc. These tell us how much the business owes. On the other hand, owner's equity refers to the money or value of property put by the proprietor into the business to start with, which also refers to the initial investment. The owner's equity will be increased by profits or additional investment and will be decreased by withdrawals, expenses, and losses. Most often, the owner's equity is the residual interest in assets after deducting all its liabilities. Therefore, these tell us how much is left for the business. So here is an example of the statement of financial position, wherein in the heading we have the company name, the Davao Laundry Services. Under it we have the statement of financial position, as well as the period as of March 31, 2028. Under it we have the three elements of the statement of financial position, the asset, liabilities, and owner's equity. Also, the total assets should be equal to the total liabilities and owner's equity. The second statement is the statement of comprehensive income. The statement of comprehensive income is previously known as income statement. This is a financial statement that shows the results of operations of the business for a given period of time. It consists of three sections, which are the revenue or income, expenses, and profit or loss. The period covered by the statements may be for the month ended, for the quarter ended, for the 6 months period ended, lastly for the year ended. Revenues or income denotes the money or proceeds from services rendered by a servicing company or income from the use by other entities of the resources of the enterprise, such as rent income, royalties, and etc. Expenses denotes the benefit received by the business from its use, which had helped in carrying out its operations, such as salaries expense, rent expense, repairs and maintenance, taxes and licenses, and many more. While on the other hand, profit or loss is the excess of revenues over expenses. So basically, the statement of comprehensive income features the following: revenue or income less expenses equals profit. And here's an example of statement of comprehensive income. We have the heading, the name of the business, the Davao Laundry Services, the statement of comprehensive income, as well as the date for the month ended 31 March 28. And then we have the service income of 80,000 less operating expenses of 56,850, which includes the following: uncollectible accounts expense 350, depreciation expense 2,500, salaries expense 10,000, rent expense 5,000, utilities expense 12,000, laundry supplies expense 20,000, taxes and licenses 4,000, and lastly advertising expense 3,000. Therefore, we have the operating income of 23,150. However, we have the finance charges, the interest expense of 1,000, so the profit for the month is 22,150. The third and the last statement for this video is the statement of changes in owner's equity. The statement of changes in owner's equity is a financial statement that summarizes the changes in equity for a given period of time. The beginning equity of the owner is increased by additional investment and profit. Correspondingly, it is decreased by withdrawals and loss. So here's an example of the statement of changes in owner's equity. Under the statement of changes in owner's equity, we have the beginning balance of S. Santos owner's equity on March 1, 2028 of 850,000 at additional investment 0, profit for the month of 22,150, so with a total of 872,150. Last withdrawal of 10,000, so the ending balance of S. Santos owner's equity on March 31, 28 is 862,150.
The statement of changes in owner's equity answers the question, what caused the increase in owner's equity of S. Santos from 850,000 to 862,150? Looking at the statement of changes in owner's equity, we say that the beginning equity of Mr. S. Santos in the amount of 850,000 has increased to 862,150 caused by the results of operations. The amount of the increase is calculated as follows: owner's equity end 862,150 less the owner's equity beginning 850,000, which gives the amount of an increase in owner's equity of 12,150. The increase in owner's equity by 12,150 can also be accounted for as follows: profit for the month, or the increase in owner's equity of 22,150 less the withdrawal or the decrease in owner's equity of 10,000, which gives the net increase in owner's equity of 12,150. To sum it up, the financial statements determine a company's health and stability, providing an understanding of how the company conducts its business. Therefore, it is essential to know the information about the financial position, which conveys the current state, financial health, and the future viability of the company, which helps these companies make informed decisions. Furthermore, it assists all stakeholders, including the management, investor, financial analysts, and others, in evaluating and making appropriate economic decisions by comparing previous and present performance and predicting the future performance and growth of the company. We have reached the end of the hashtag Just Accounting series. I hope all of you had fun learning from the beginning up to the last episode. And that's all from your hashtag Just Accounting family. And again, I am Jonalyn Arfrando. Be sure to support the next series on this YouTube channel. Please subscribe, like, comment, and press the bell button. And also, follow us on our social media accounts to be updated. Thank you again, and may God bless us all.